Some institutions like BlackRock, JP Morgan and Wells Fargo have vast data and information, and they are cautioning against premature expectations of rate cuts. BlackRock's warning focuses on the disappointment in rate cut expectations and advises stepping back from longer maturity bonds. It suggests that this will not happen as early as anticipated, and there is a risk of higher volatility. The banks hold unrealized gains in bonds, and a drop in their value due to rising rates will significantly impact the market. The current excitement about the Federal Reserve lowering rates has led to increased prices in gold, silver, and Bitcoin, as well as overvaluation in the stock market. Additionally, the gold is hitting an all-time high. Central banks, billionaires such as Warren Buffett, Paul Tudor Jones, and Sam Zell are amassing gold as a substitute for conventional securities like mortgage-backed instruments. This surge in gold prices depicts a more extensive movement towards safer assets, underscoring apprehensions about the state of the global economy. These developments head towards the beginning of a liquidity crisis. The traders and investors are positioning themselves based on this assumption. The recent run-up in prices will not be sustainable once traders realize the Fed is not going to cut rates as early as expected. BlackRock oversees an astonishing $9.4 trillion in global assets, surpassing the combined economies of 70 of the world's most populous nations. The trillions of dollars under its management make it an indispensable resource for investors, policymakers, and finance professionals. Their strategists expect any easing by the Fed to begin in the middle of the year, and they cautioned against premature optimism. There is a disconnect between cyclical narratives and structural realities. The global economy is being shaped by structural drivers. These include geopolitical factors, shrinking workforces, aging populations, and the transition to a low-carbon economy, which will cause inflation above official targets and increased uncertainty. BlackRock has downgraded its longer-term strategic view on developed market stocks to neutral. This decision is attributed to rich valuations, perceived risks, and a weak financial outlook. However, they maintain an overweight stance on artificial intelligence-related companies. They suggest a cautious approach, acknowledging the complexities of the current economic environment and advocating for careful consideration in investment decisions, especially in response to expectations around borrowing rates. They have also cautioned against broad market exposures like the S&P 500 for many months. It suggests that latest investment commentary retains a tactical underweight to the broad U.S. market, stating that they don't believe earnings expectations reflect the macro damage they expect. The United States has a significant debt burden, and if borrowing costs stay near 5% in a few years, the government will find itself spending more on interest payments than on healthcare benefits. This scenario raises alarms about the sustainability of such high levels of deficit, which will lead to entrenched inflation and stumbling growth. If the government has to allocate a substantial portion of its budget to interest payments, then it will struggle to respond to a faltering economy with aggressive rate cuts, as seen in the past. It will also have implications for annual percentage rates, inflation and growth. It will limit its ability to respond to downturns. The companies which are influenced by annual percentage rates will choose between taking loans or selling shares. The changes in interest rates can affect the crypto market as predicted by banks like Bank of America and Deutsche Bank. There are speculations that BlackRock will be front-loading Bitcoin through miners, negotiating lower fixed prices for larger amounts. A significant percentage, around 80% of institutional investors, currently have zero exposure to Bitcoin or similar digital assets. Many institutions only have minimal indirect exposure through ventures or investments by individual members, and they will be deemed fiduciary irresponsible if they continue to have zero exposure, as it is uncorrelated to bonds and having a low correlation to stocks. The stocks, when valued in gold, have not shown significant gains over the years. Consensus forecasts indicate economic growth will slow sharply, with real GDP expanding at an annualized pace of just 0.4% in the first quarter and 0.3% in second quarter, down from an estimated average of 2.5% in 2023. Treasuries will also be impacted by re-emerging risk factors, which were made clear during last quarter's bond market crash. These include an oversupply of Treasury assets, increased federal deficits, and loss of traditional market buyers. The financial landscape is affected by zombie companies who barely make enough money to cover bills and debt, but are not sufficient for growth. This phenomenon has grown from 1% of companies in 1997 to 18% today. Banks' forbearance, government policies, and the fear of job losses contribute to the survival of them. They hinder economic recovery, redirect resources from productive firms, and stifle innovation and productivity. In 2021, Goldman Sachs reported that 13% of the United States listed companies can be considered zombies. Various financial ratios such as interest coverage ratio, debt, and compound annual growth rate are used to identify them. A correlation between low annual percentage rates and the rise of them is observed. Some of them received bailouts, raising questions about the impact of government support on maintaining them. Investors have to be cautioned against overlooking these signs. Some recognizable names like AMC, Virgin Galactic, Lionsgate Entertainment, Norwegian Cruise Line show distress signals. Larry Fink is the head of BlackRock, and his insights are highly respected in the financial world due to his vast expertise and commitment to broader issues like corporate responsibility and sustainability. He warns about the repetition of mistakes from the 1970s, citing historical parallels, and emphasizes the need for policymakers to avoid errors related to energy sources and inappropriate monetary policies. He predicts higher interest rates, but is optimistic about the long-term financial outlook, which is rooted in technological intervention. Companies like Nvidia, Alphabet, DeepMind, OpenAI, and Tesla are leaders in technological progress. AI investment is seen as fostering efficiency, data analysis, personalization, and innovation. High efficiency through automation, data-driven decision-making, and competitive advantage are important. The healthcare sector benefits from artificial intelligence in disease diagnosis, drug discovery, and patient care. Investing in this sector is considered crucial for long-term growth and a foundation for progress. There is a substantial increase in wages, with labor settlements reportedly at 25%. Despite this elevation, he sees more trouble on the horizon. Fink's insights are considered crucial in shaping financial perspectives. He believes that the Federal Reserve will need to raise borrowing rates higher than expected, indicating challenges in the labor landscape. The U.S. deficit has increased from $8 trillion in 2000 to a staggering $33 trillion, raising inflationary concerns. The Federal Reserve's balance sheet is seen as contributing to inflation. A significant amount of fiscal stimulus is entering the economy, which is approximately $970 billion. Heightened concerns about immigration, particularly the lack of legal immigration in economies like the U.S., are also drivers of inflation. The United States faces a challenge with its escalating deficit, outpacing income growth. The elevation in real interest rates is deemed essential for creditors to attain a sufficient return. The government distributed funds through checks to support households, which heightened the deficit. The upward trend in borrowing rates impacts savings and generates a deficit maturity squeeze. The gradual transfer of wealth from the government to the private sector is contributing to an incremental weakening of the economy. Long-term concerns arise regarding borrowing to manage the deficit. The United States is currently grappling with a supply and demand issue, as about 40% of its debt is sold to foreigners. Internal political and social conflicts are expected to impact foreign demand, so it needs to achieve strength by maintaining a balance sheet with more assets than liabilities. The accelerating deficit poses a challenge, necessitating careful navigation. Bond yields indicate a need for a real interest rate, approximately 1.5 to 2% above the inflation rate, to ensure satisfactory returns for creditors holding debt assets. This suggests an overall interest rate in the range of 4.5 to 5%. Concerns are raised about the appetite of buyers, including central banks and foreign investors, as the government issues bonds equivalent to the size of the deficit, creating a supply-demand issue. There is a rise in term premium, which refers to the compensation investors demand for holding long-term bonds. The impact on investors is multifaceted, as it is influenced by fiscal stimulus, inflation, historical context, and the transformative power of technology. They are encouraged to navigate these complexities with a focus on informed decision-making and awareness of challenges and opportunities. A looming banking crisis with over $680 billion in unrealized losses reported by U.S. banks, particularly on treasuries and mortgage-backed securities, which constrain the bank's ability to lend. The Federal Reserve's aggressive interest rate hikes are a significant factor contributing to the situation, causing a decline in the value of securities. Financial institutions are managing the damage through short-term bailout programs, but these are the temporary solutions. Additionally, concerns are raised about the impact on the global economy, with Moody's issuing a negative outlook for the sector in 2024 due to a deteriorating operating environment and rising delinquencies. The dependency of the US on foreign lenders and the increasing national debt are the reasons for the uncertainties. The current financial landscape is vulnerable to the challenges posed by unrealized losses and interest rate fluctuations. American consumers face problems with increasing household deficit, diminishing savings, and a growing dependence on tapping into retirement accounts. The mainstream media and the Federal Reserve are portrayed as minimizing concerns about inflation. There is contrast between the officially reported inflation rates and the genuine difficulties that consumers are grappling with. This has resulted in a situation where a growing number of individuals find themselves unable to cover emergency expenses, contributing to heightened distress. Europe is also experiencing economic difficulties, with Germany entering a recession, which will bring a similar trend like the United States. The world is experiencing significant financial shifts, marked by political polarization, supply chain complexities and fragmentation, leading to inflation. Stakeholders are urged to develop a robust framework to safeguard against uncertainties, while individuals are advised to adapt their financial plans in anticipation of challenges. Comment down below on what you think, and if you liked this video, please consider liking, subscribing and sharing the video. Thanks for watching, and we'll see you in the next one.